We are coming to you in a time of tremendous turmoil, to say the least. And we're going to focus our remarks here largely on oil and energy. Without a doubt, the circumstances facing the world and the United States are much deeper than oil and energy. And our thoughts and prayers are with everybody who's dealing with the coronavirus in real time on the front lines. We're fortunate enough to be able to, work from the safety of our own homes and come to you live through this venue. Thankful to the staff at the Baker Institute and the great work that they're doing to help put this together. Without a doubt, we have been thinking about what's going on in oil markets and energy markets more generally ever since this massive demand shock sort of hit the global market. And it kind of started in China, really, and then began to matriculate out. And it's been, without a doubt, a tidal wave. But it's been exacerbated in many respects by the price war that, and that's a colloquialism, but the price war that's been launched really between Saudi Arabia and Russia, as it's been characterized. So we wanted to today try to bring some context into all the things that are flying around in the general media about these issues. And to do so, I think what I'm going to do is turn it over first to Mark Finley and have him introduce himself a little bit more generally and have him share some thoughts on the issue. And then we'll turn it over to Jim Crane and he'll do the same. And I will preface everything by saying that the three of us are working on a short paper that will highlight our thinking, much of which will come out in the conversation today, but highlight our thinking on this issue. So with that, I'm going to pass it over to you, Mark.
Great. Well, thank you so much, Ken. And let me add my thanks to all of you who are joining us online for this webinar. I noticed it's billed as a happy hour, and you'll see my bottle of wine over my right shoulder. It's difficult to find anything lighthearted or fun in these circumstances, but I think there's certainly lots of evidence from the medical profession about the power of trying to find positive things, and so I hope that you'll all be able to find some way to relax this weekend as well. And because certainly if you don't drink already, what's going on in the oil market now is enough to make you get there fast. I've been studying world energy and oil markets for 35 years, and this is what we're going through right now is truly an unprecedented change. And nobody, to be honest, nobody knows how this is going to play out. And so it's important to be humble as we think about where we find ourselves and where we're headed. You all know the context. The price of oil from earlier this year had fallen by about 2/3. WTI was briefly flirting with 20 bucks, the lowest levels in 20 years. They've rebounded in the last couple of days on talk of potential production cuts. On my screen before we started the call, WTI was near 29 and Brent was about 35 bucks. At its heart, this is a demand story. Global demand is collapsing due to the shutdown of economic activity, especially the transport sector, as people and governments respond to the spread of the coronavirus. Things are moving very fast. There's no real good data out there, but estimates of the current snapshot of global oil demand destruction range, well, up until yesterday, ranged up to over 20 million barrels a day. One of the major trading houses today is saying they think it could be down by as much as 35 million barrels a day. But to keep some balance, let's go for 20 million barrels a day, which is already a spectacular decline. Indeed, it would be the biggest decline of oil demand that we've ever seen. The previous biggest decline on an annual basis was that we saw a 10% decline in global oil demand over a 3-year period from 1979 to 1982. And it's worth reminding ourselves what it took to make worldwide demand fall by 10% back then. We had the second oil shock with the Iranian Revolution, the Iran-Iraq War. We had a deep global recession impacting demand. We also had structural demand losses in power generation with the ramp up of nuclear power, in parts of industry as oil was eliminated as a boiler fuel, et cetera. It took 3 years back then for oil demand to fall by 10%. Now we've lost 20% in a few weeks. Just the pace and the rapidity of the decline is truly without precedent. And as Ken mentioned, as if that wasn't enough, we're now seeing a price war as well among suppliers. Heading into last month's OPEC plus meeting, OPEC and the Saudis wanted to cut production. Russia wanted to roll over. When the two sides couldn't come to an agreement, instead they went to an all-out price war, saying all production restraint is off from April 1st, and member countries are free to produce whatever they can or want to do. Saudi Arabia has ramped up the supply to over 12 million barrels a day from about 9.5 before, and is also planning to raise its production capacity further to 13 million barrels a day. Now, note the relative changes that we've talked about so far. 20 million barrel a day loss for oil demand, an extra maybe 3 million barrels a day for supply. This is a demand story. Now, where do we go from here? It's still a demand story. So the key uncertainty going forward is how deep and how long lasting is the economic and policy impact on demand. We are beginning to see oil demand in China recover, having been first to experience the virus and its economic impact. But even there, consumption is still way down. Meanwhile, here in the United States and in Europe, the declines are only accelerating. On the supply side, the news in the last 24 hours is a talk of re-engaging among producers to orchestrate coordinated production cuts. That was fast. Usually, price wars need to wait for the pain to really sink in before the producers can get together. One thing that has been very striking is President Trump's reversal. He went into this saying, I like lower oil prices. It's good for prices at the pump. He is now, of course, very actively engaged in trying to bring the Saudis and Russians together to coordinate production cuts, a shocking illustration of the implications of the shale revolution. I think the president is meeting today with oil industry executives who then have follow-on meetings with other senior figures in the administration. And so we will see what the discussion is of U.S. options and authorities for orchestrating production cuts. In addition to that, the Railroad Commission here in Texas has announced its intention to host an e-meeting on the 14th. But frankly, the U.S. production cut is already coming. The Railroad Commission just in the last couple of days released data showing that January oil production in Texas is already down 400,000 barrels a day from December, following on what looked to have been declines in the rig count over the back half of 2019. More recently, the U.S. rig count has responded very rapidly to the more recent decline in prices. The rig count's down 100 just in the last 3 weeks alone, surely with more to come. And so I think to some degree, a decline in U.S. production is already built into the numbers. And it's worth in that context remembering how Russia has in recent past, engaged in the coordinated production cuts, agreeing that they would cut production, but saying, but it'll take us 3 months to work that into our system. So that's a potential hint about how U.S. engagement might play out. There's a meeting of the interested parties, again, virtual meeting on Monday. It's interesting to me to note that the Saudis are now saying that essentially they're offering 3 million barrels a day of production cuts. In other words, they're offering to cut back to where they were when they started, having just increased production by about 3 million barrels a day. What's in the public domain is that the interested parties are talking about coordinated cuts of about 10 million barrels a day. But remember, demand is down 20. While these cuts are unlikely to balance the market, they can buy time, and we'll come back to that shortly. So for now, the market is massively oversupplied and likely to remain so for the near term, even if there are production cuts that are agreed and delivered. Inventories, therefore, which are already rising, are likely to continue to do so. And that is the real risk and the real opportunity here. If global oil storage fills up, prices could fall even significantly lower than they had been at their bottoms a week ago. Because what would happen is there would be no option for storing surplus oil, and prices would have to fall to force existing production to shut in. Now, the speed of this fill is massively uncertain. Estimates had ranged from a few weeks to the better part of the year, but whatever your estimate of storage capacity is, coordinated production cuts buy time. So there's lots of uncertainties about the capacity of the system to store oil, capacity for floating storage, the maximum rate at which storage can be filled. But I think, to me, the key point out of the last 24 hours is that production cuts can buy time to at least, if not support prices, avoid another downward leg. Now, if we get to the point of requiring, if even with all of this, storage does fill and prices resume their downward momentum, what would the candidates be for shutting in existing production? We've seen a few small announcements: Brazil shallow water, some Canadian oil sands projects, but those aren't nearly enough. We've actually got some work going on at the Baker Institute that we hope to publish shortly that will illustrate some of the other high cost sources of supply that might be at risk, should global storage fill and prices need to fall further to keep the market in balance. With that, why don't I pause and let Jim have a say.
Great. Thanks, Mark. And real quick, Jim, before you start, I want to emphasize that we have been receiving questions, and I will get to those as soon as Jim is actually done with his remarks, and we sort of dive into some of the issues that have been raised. Okay. All right, Jim, turn it over to you.
Well, thanks a lot, Ken. So I'm Jim Crane, the Wallace Wilson Fellow for Energy Studies. I tend to cover energy and geopolitics. So I look especially closely at the Middle East and what Saudi's doing. So appreciate you all coming. I'm actually kind of glad I can't see you all. I hear it's a pretty big audience, and it's a bit more comfortable for me to address it without actually having to look out over a massive audience out there in Baker Hall. So let's take a look at maybe the supply side of the story. I know Mark has mentioned that this is really a demand story, and I completely agree with him. But there are lots of interesting things to talk about on the supply side too. There have been, you've probably heard, some really interesting U.S. policy proposals that are coming down, floating around the media. Everything from we're going to sanction Saudi Arabia or put punitive tariffs on Saudi oil exports to actually cutting production of our own and becoming a virtual member of OPEC. So I think there's a lot of confusion around this, I think a lot of that is based on maybe almost like a bit of schizophrenia in the U.S. here. It's like we are now the largest oil producer in the world and the largest oil consumer. So what do we do? We've got almost equal interests on both sides of these questions. So do we act like pursue our interests as this new oil producer, or do we follow our traditional role as a big consumer? There's a lot of questions about that. I think that's leading to a lot of policy confusion in Washington. I think that Trump administration is trying to hammer that out as we speak. I think if we did actually put punitive tariffs on the Saudis, I think that'd be pretty symbolically damaging to a really long-standing, close relationship, and I don't think it would do much to help U.S. producers. So hopefully things won't go in that direction. But let's look at this price war that we're hearing about that the Saudis launched early last month. Why now? I think it's pretty clear that this was an ill-timed price war, but I think the context was a bit different at the start of this price war when the Saudis stormed out of the OPEC meeting and decided, instead of cutting another 1.5 million barrels a day, they were going to ramp up production by more than 3, right? So now most countries, it should be clear to you, can't do this, right? So most countries can't just ramp up their own production by 25% in the matter of a few weeks, right? But the Saudis are special. They can do this because they've got spare production capacity that allows them to do this, okay? So this is a huge capital investment that sits idle most of the time, okay? And they do this because Saudi Aramco is a government-owned company. No publicly owned company that had to answer to shareholders, at least for the majority of its ownership, would ever invest in spare capacity. I mean, can you imagine shareholders would be aghast. So normally the Saudis use spare capacity to reduce volatility in oil markets, and they do this for a number of reasons. They do it because they want to protect a long-run demand for oil. So if oil prices are swinging all over the place, it's unpleasant for consumers like us, and that they want oil to be attractive in the long term. They want oil to maintain a price advantage over alternate fuels and technologies, right? So they want the internal combustion engine to compete well and be cheaper than the electric vehicle, for instance. So this is in the Saudi strategic interest and its long-term economic interests. But it's also in one of the things that makes Saudi a key partner of the United States. When the Saudis bring that spare production capacity online, it's often done in concert with the U.S., right? So when we decide to put sanctions on Iran or invade Iraq, or when Iraq invades Kuwait, et cetera, the Saudis bring their spare production capacity online. I like to say that the Saudis protect the U.S. motorist from U.S. foreign policy. But that gives the kingdom a lot more geopolitical power than it would otherwise have. And then this spare capacity, is one of the key reasons that we spend so much protecting them and keeping so many troops in the Persian Gulf. However, now, be that as it may, right now, the Saudis are using spare capacity not to remove or to assuage volatility in the oil market. They're doing the opposite, right? So they are they're actually exacerbating volatility by using their spare capacity. So what's the deal with that? So I think what's going on here is that at times when Saudi Arabia feels that cutting production and continued cuts is engendering excessive free riding on their sacrifices, when they're, as they say, carrying the oil sector on the global oil market on their own backs, and they're not seeing other countries making similar sacrifices, they'll use that spare capacity as a deterrent. Okay, so the Saudis have always made clear they're not going to do this alone, and they're saying that again right now. Okay, so they've done this, famously in 1986 after all the cheating around OPEC. They did an about face, and I think they had cut by that point 6 million barrels a day, 5 or 6. I think Mark can chime in on that, but they did an about face, opened the floodgates, pushed oil down to like $12. They did it again in 2014, okay, which probably a lot of you remember. This was under the oil minister Ali Naimi. Similar circumstances to today. Russia and some others refused what Naimi was describing as reasonable cuts, and then they opened that time Saudi just didn't cut. Now Naimi in 2014 sounds a lot like what Russian oil minister Novak was sounding like last month, saying, yeah, we don't want to subsidize shale. We don't care if the oil price falls to $20. So they're using the price war this time around as a punishment mechanism. But so the next question, I think, is that how long will this price war last? So these things can drag on for years. We had a long oil bust after that price war in the 1980s. It didn't end until 2003. But this time around, I suspect it's going to be short-lived because there are structural reasons for it, and Mark was talking about those. Limited, you cannot just bring impossible numbers of unlimited barrels of crude to market without having a place to store them above ground. And as storage starts to tighten up and run out, and you're already seeing a companies looking to rent ships, and now even rail cars, rail tank cars. So as that that storage fills up, I think there will be structural reasons for them to have to call off the price war. And indeed, it'll probably happen even before that. I mean, it could happen as soon as, potentially as soon as next week, if they, if we get what the Saudis and Russians think of as a decent agreement. I think there's a lot of tension in the media about which of these countries can survive the longest on low oil prices. I think that's um, really not where we're at. Yeah, both of these countries can survive for multiple years of very low oil prices. I think that's pretty clear. But I think this price war is going to be over before those sorts of defenses are ever tested. I think it's really as Mark said, the demand story, this demand shock that's really tearing things up right now. Yeah, why don't I'll leave it there for now, and then we'll cut over to the Q&A. Thanks.
Great. Thanks, Jim. Lots of questions pouring in. Lots of questions I received. Actually, we've received pre this webinar, but there's a couple of data points I just want to throw out there and kind of turn this into a little conversation, if you will, for a few minutes before we get into questions, because and I apologize if I don't ask your specific question, but a lot of the questions are similarly themed. So I'm going to try to construct them so that I kind of weave through everything that is on people's minds as much as possible. But Jim, in his remarks, actually mentioned concern that has been expressed actually both within Russia and for a long time within Saudi Arabia and OPEC related to withholding production and that actually supporting price and allowing shale to grow. I'll just give you some context to that. I actually spoke at an OPEC meeting about 9 years ago now. And I was asked by 8 different delegations at that meeting a question that was effectively aimed at trying to understand what the break-even price of shale is. I tried to tell them, even back then, that there's not a single break-even. It's actually quite a heterogeneous distribution of costs across producers and across acreage. But they kept looking for that single number. And it was clear really what the motivation for that was. It was, how do we actually make sure this doesn't grow too much? And what you've actually seen since 2016 is a production strategy on the part of OPEC and Saudi Arabia in particular, whereby they have actually cut production collectively since 2016. And at the same time, you've seen production from the United States increase by, and this is total liquids production, but by about 4.5 million barrels a day. So the concern that Jim referred to with regard to free riding, et cetera, is something that has been very much voiced in the OPEC circle for the better part of a decade. So we can't discount that as a motivator for what happened. But I think it's important here, and I'm going to steal a phrase from Mark, it's because where I heard it first, not to use a lot of ex post rationalization. So not to come up with an answer that seems plausible and sounds reasonable and assume that's the motivation, because in point of fact, none of us really know. Going into the last OPEC Plus discussions, there was a general view that there would be a cut coming out of the back end of that. And of course, that didn't happen when the negotiations fell apart. So that, of course, supports the thesis of it's a punishment strategy for non-compliance. But again, that's potentially an ex post rationale. At the end of the day, there's a lot of different things that can be thrown on the table as potential explanations. I think one thing, though, regardless of what view you might actually have and how you might think about motivation, I don't think anybody fully internalized the depth of the demand collapse that we've seen. And I think that's got a lot to do with why there's significant interest in on the part of all these players to come to the table and agree on a potential course of action whereby production is reduced. Because even for countries like Saudi Arabia and Russia, if you fill up storage and demand destruction does reach a astronomical number that Mark mentioned of 35 million barrels a day, storage is going to fill incredibly fast, regardless of what happens with the cuts. And production is going to have to be shut in all over the world. And it's going to vary by cost structure, by location. And that's another point we didn't even raise. Typically, people like to talk about break-evens in terms of benchmark prices, but it's important to realize that there are there are areas around the world that are seeing much more pain simply because there are additional bottlenecks to get away from places like the Eagle Ford or places like West Texas, North Dakota, et cetera, et cetera. And that actually puts additional pressure on producers in those regions because prices get discounted relative to the benchmarks that we often talk about. Now, there's quite a few questions that have come in related to motivation, but also related to where you think production is going to decline first, where we might actually see some shut-ins. That is analysis that we have ongoing, and Mark alluded to some of that. So some of the Canadian oil sands production, some of the stuff in the North Sea, smaller producing wells, some shallow water stuff in Brazil. There's a lot of things that are on the table, but one of the things that's important to understand is there are also producing assets that are, if you just construct a typical cost of supply curve, look like they would do well against the benchmark price, but they are also regionally constrained. This is why I raised that issue a minute ago. So it's likely you could see some production shut-ins that culminate ultimately because there's nowhere else to put the oil locally, and there's no reasonable offtake. So it creates a bottleneck that's local rather than global. With that, I'm going to turn to some of the questions that have come through, and I'm going to try to frame the first one in a broad context because it'll open it up, I think, to some discussion. There's quite a few questions that really address the idea of political or policy intervention and what it could mean. And I think both Mark and Jim have referred to this to some extent in their remarks, but I think perhaps it's worth a deeper dive. Some of the questions have focused on the likelihood of curtailments that are politically motivated or regulatorily motivated in the United States. So for example, what the Texas Railroad Commission could do, potentially even what the federal government can do in terms of offshore production. That was actually something that I saw in an article this morning with the potential for certain conditions being offered to offshore producers to temporarily shut in production. I think it's important before we go there to also address something that was raised. I had a long conversation in the questions. I had a long conversation over the weekend with a geologist and reservoir engineer who's been in the industry for over 20 years because I had the question too, because it'd been posed to me and I couldn't think of an example where it was true. But does shutting in production damage a reservoir? And he said in his entire career, he didn't know of a single instance. And I couldn't think of one anecdotally that I had heard of. So he said, in fact, a lot of times what can happen when you see shut-ins is particularly in relatively early life, you can get repressurization in a reservoir, and that can actually help production when you reopen it. Again, I don't think there's a lot of concern around that particular aspect unless you start talking about shutting them in low pressure, low producing wells. Those typically aren't going to be brought back online. So that's where we get into the small production, like from stripper wells and stuff like that. So, with that, I want to turn it over to Mark and Jim. Maybe you have some comments you want to share about policy intervention. Now, I know, Mark, you've written some stuff recently on what's going on that front. So maybe you want to kick it off.
Right. Okay. Well, thanks, Ken. Well, I guess I would start with my original premise, which is that this is in the first instance a demand problem, and so I think in terms of policy perspectives, one of the best things the U.S. and global governments can do is work to minimize the overall impact of this virus on public health and therefore over time on the economy. And to make sure that there's a robust safety net for workers / consumers who are impacted by that. And that was part of the theme of my piece. And I think it's important to acknowledge that the pain here. Companies are at risk and people are losing their jobs. I mean, the number of new unemployment claims in the United States last week was 10 times bigger than the previous all-time record, except for the week before that. The week before that was 5 times the all-time previous record. Last week's was 10 times the previous record. So it's staggering the adverse impact on the workforce that we're seeing from this. So managing the adverse economic consequences of the virus in its totality would seem to me to be the best thing that the government could focus on. On the supply side, one of my thoughts is that there are clearly things that are within the government's scope to do, but I think it's also worth remembering what brought us here to begin with, which was the spectacular system that we have here in the United States that encourages risk-taking and innovation that brought us the shale revolution to begin with. And the flip side of the coin of the opportunity to innovate and make money is managing the risk that comes with that. And here we are with the risk side of it. I think it's important that we not forget that first principle as we seek to try to manage the adverse consequences of this.
Great. Thanks, Mark. I don't know if you want to expand at all on the the hearing that's going to take place on April 14th with regard to the Railroad Commission, and I think you hit the nail on the head there in terms of engaging or embracing free market enterprise. But there has also been proposals related to raising tariffs or using anti-dumping rules under the Trade Expansion Act. I think that's Section 301 to levy tariffs on Saudi imports. Just share your thoughts on that. Does it make sense? I'm kind of asking you a leading question there, but
as a couple of economists talking to each other.
Right.
Look, I freely admit that my market bias, and so the extreme movements of prices that we've seen, both on the way down and the last couple of days on the way up, emphasize the extreme imbalances that these markets are coping with. And frankly, the way the market signals these things is through prices changing, and allowing the prices to change and allowing both producers and consumers to respond to them. It gives the most efficient solutions for society as a whole. And I've always thought, actually, I don't want to sound insensitive in these remarks, because I recognize the pain. And I mentioned a piece that I wrote earlier this week that I lived through it. My dad lost his job in the first oil shock. But at the same time, I think it's important to recognize the awesome power of these forces and the tremendous benefits that have accrued to our country from them. The United States became the biggest producer of oil in the world on the back of these spectacular innovations of shale that wouldn't have happened, in anything other than the system that we have, to the system of free enterprise. Shale rocks are ubiquitous around the world. What's rare is what's above the ground.
Jim, I don't know if you want to add to that context.
Yeah, real quick. I might just chime in real quick. I saw already a question popping up that was related to this anyhow. So yes, I think the U.S. Taking a kind of an OPEC style market management role is going to be an unfamiliar and uncomfortable place to be, but we may have to do something like that here in the, because I don't think the Saudis and the Russians are going to get on board if we don't. We have to do something. We could probably, the U.S. government, Trump administration could probably, use some type of coercion, a sort of punishment strategy to try and, bring the Saudis on board. It wouldn't work with the Russians, but I don't think long term that's a healthy thing, a healthy place to be. So it may actually be that in some form or another, that the U.S. may have to agree to some type of mechanism for reducing oil production. And so whether it's through the Texas Railroad Commission or some other way, and of course, one of the ways they could do that is, without actually demanding that that producers stop producing or trying to set quotas or anything like that. They could just enforce environmental regulations, as we've been discussing amongst ourselves, right? There's lots of flaring regs that are already on the books that aren't being enforced, or stop giving out permits extensions to continue flaring. And you'd probably take some of the less efficient oil production offline, at least temporarily, while they were able to get takeaway infrastructure for that gas that's now being flared or even vented. So some of this could be done, in an environmentally and beneficial, responsible way. So I'll leave it there, and see what other questions come up.
Okay. So I'm gonna shift gears a little bit, just being conscious of time, to try to weave through some of the other questions that have come in. And by all means, for those of you that you have questions, even post this webinar, we're going to be continuing to do more and more stuff like this. So definitely stay tuned and engaged, because this is an ongoing conversation. It's not going to end as soon as this meeting's over. But on the demand side, there's a recognition generally that there's a tremendous collapse in consumption globally. And several questions have come in related to what does recovery look like? And is it complete? Or as some prognosticators have actually put out there, have we actually seen a peak in demand? So I'm going to flip that over to you guys and get your thoughts on that.
Well, as always in the field of economics, the answer is it depends. I mean, as I mentioned earlier, I mean, the depth and length of this, of the coronavirus impacts. I mean, most macroeconomists are expecting, that the U.S. and world economy will begin to recover, in the back half of this year, and oil demand should come right along with it. I think that there's a potential for some longer lasting impacts if it adversely impacts, for example, international travel. But we saw after 9/11, after coronavirus, or after SARS, that there were impacts, and some of them lasted for several months. But it's worth remembering that heading into this, even after all of those events, world oil demand last year was at an all-time record high level, and people had been expecting it to continue to grow this year, even before that. And I know, Ken, you have some thoughts on, in addition to the natural recovery, the potential for a hypercharged one on the back of all of the stimulus that the U.S. and governments around the world are releasing into the system to combat this. So it is, as dark as the picture is on the short-term demand destruction, it is worth remembering that most people believe that this, that the bottom is in the months ahead, and then things do recover. And the pace of the recovery, Ken, you may want to elaborate on.
Sure. You're right. I do have some thoughts on the role that stimulus is playing.
Like we talk to each other.
Yeah. Without a doubt. There's been a tremendous amount, and likely to be more, fiscal stimulus pumped into the U.S. economy, but also economies around the world. There has also been a tremendous amount of monetary stimulus introduced. And this is, monetary stimulus. This is basically increasing liquidity, cutting interest rates to zero. The two have different impacts, right? Fiscal stimulus is really designed to help in the immediate term. It's going to help, small businesses and households weather this storm. When you think about the monetary stimulus, that has potentially longer term ramifications, because you could actually see, if there is a significant enough reduction in supply over the short to medium term, and a stimulus-backed sort of massive recovery in demand, a spike in price. In which case, capital markets are going to look at energy markets generally, not just oil, but energy markets generally in a much more favorable light. And that could actually have significant issues structurally for the way not only demand recovery mounts, but also supply recovery, and what that means longer term for the future of oil and oil market balance. So I think that's something to watch. I think the longer this drags out, though, the longer the negative impact on demand drags out, the the more unlikely it is to see a rapid bounce, because you begin to have structural implications on the underlying economic system. I think that's something we all have to remember. There really wasn't anything wrong with economies around the world coming into this. Everything literally shut down overnight. And in many ways, it's emanated from the service sectors of economies. So you think about restaurants and hotels and airlines and other things being the most severely impacted in the immediate term. Those are typically the industries that are the most resilient during times of economic downturn. So this is, again, as Mark and Jim have both said, this is unprecedented. It's a very different type of event we're living through. And it's one ultimately that time is of the essence. The more rapid governments can adequately address fear, the more rapid things will turn, and we'll all go back to some semblance of normal. What that looks like, I think, remains to be seen. There's a lot of discussion out there about the work from home actually being effective. I can tell you from my perspective, it is to some extent, but I do miss the conversations in the hall. Because they're spontaneous, they're intellectually stimulating, and they're just not happening right now. And I think there's a lot of people that probably feel in a very similar way. So I don't fully anticipate everybody just stop going to the office, even when this subsides. So the other quick question that I want to raise, just being conscious of time, is really focused on how deep, and I kind of hinted at this already, but how deep is the shock, and what implications do you think it has? And this is something that's come up in multiple questions that I've seen for this being an election year. What implications do you think it has for the political system in the United States, and what could potentially transpire? And I think a lot of this really does boil down to spin and voter perception, but I don't know if either one of you want to wade into that and maybe have a comment on that front, but I'll turn it over. Maybe I'll start with you, Jim, on that one.
I mean, nothing leaping to mind here. I can't imagine that if we had a changeover in political parties, that there'd be any less impetus to get this thing behind us. There might be a little bit tougher love for the oil sector than you might see under a Republican administration. You might see less willingness to give direct financial aid or tax breaks to oil and gas. And I think when you start looking at green stimulus packages and some of this is being talked about, or the notion of let's consider climate change before we get too deep into this. Some of these, as that thinking starts to penetrate, if this crisis is still going on, there could be folks that are coming to office and say, well, look, oil and gas is an industry that's contributing to climate change. Combusting this stuff is bad for the planet, and so that this is an industry that needs to shrink anyhow. So there might be less of depending on who it is and what type of majority, there might, but again, a lot of this policy, what happens in oil and gas in the U.S. is they get their signals coming through the markets first, and through state policy second, and federal government third, right? So the federal government just, they seem to have their influence on the margins rather than centrally.
Mark, do you want to add anything to that?
No, in the interest of time, I'll defer to Jim on that one.
Great. All right. So there is one interesting question, and it kind of relates to the one I just asked, that I thought worth asking, because I've seen this in sort of different ways weaved through questions that have come across both before and during this discussion. In particular, there was a note made specifically by one viewer that there have been massive commitments to addressing climate change on the part of governments around the world, and some more than others, but massive commitments nonetheless. And the question was raised, if similar efforts have ever been launched related to the control of infectious diseases, and if you think that this might actually stimulate a shift in thinking in a lot of governments around the world towards addressing that as a more imminent threat than climate change, or if you think they'll both carry equal weight going forward. I think that's an interesting question to ponder. Honestly, it's not one I'd even thought about yet, personally, but I don't know if either one of you have any thoughts on that.
I mean, to me, it looks like the reverse. I mean, it seems like the climate question, there's a lot of talk, not much action, not a lot of hard and fast policies that, you're not seeing a 2 trillion climate bill, marching through a divided legislature being signed by the president. So I think there's much more. This is a here and now crisis. It's not something that one administration can punt on and pass to the next. So I don't know. I kind of disagree with that analysis.
I mean, I think the to sound a more optimistic note, I think that the when the combination of political will and popular sentiment and market forces all point in the same direction, we've seen significant changes in the global system in the past. And for example, you need to look no further than energy. I mean, we made some references to it earlier. After the oil shocks of the 70s, we saw a real political consensus that something needed to be done. We saw on the supply side opening up of developments in Alaska, the Gulf of Mexico. We saw fuel efficiency standards. We saw nuclear power. And the result, as Jim referenced, I looked up the data while you were speaking. I mean, 1981, Saudi Arabia produced 10 million barrels a day. By 1985, it was 3. Because what happened in the U.S. and around the world, turned the whole oil market on its head in a really short period of time. So, I think there's entirely fair questions like Jim raises about whether the political and popular will is really there. But if it is, combined with market systems, you can effect spectacular changes, in a relatively short period of time.
Yeah. So I'll add something to that that is really related to some work that we've been doing. In particular related to carbon mitigation. We're involved in some conversations at the state level here in Texas about ways to reduce the carbon footprint of the industrial sector. So this goes beyond just oil and gas. It's much bigger than that. And just to put it in perspective, Texas produces or accounts for its industrial sector about 25% of the United States' industrial emissions of CO2. So addressing industrial emissions in the state of Texas would go a long way towards addressing CO2 emissions from the industrial sector nationwide. It also speaks to how large the sector is in Texas and what it means for the Texas economy. In the conversations that we've had just in the past month, as all of this has been unfolding, it has become pretty clear to me that there is a lot of appetite for relatively easy wins politically, and ones that won't necessarily involve incurring a massive expenditure or cost in terms of tax breaks. And interestingly enough, there's a lot of things on the regulatory front, just in terms of defining a regulatory environment that is more conducive for certain types of things that can be done, particularly related to carbon capture, for example, or related to nature-based solutions and how they're accounted, that really don't amount to a big cost, but do require some legislative clarity. And so I fully expect as we move beyond the coronavirus for those to be the first things that are ultimately tackled. And now it doesn't mean that oil and gas is going to stop. In fact, capital stock that's in place right now that consumes oil and gas as a fuel is still there. It has not been destroyed. So as the economy begins to recover, those capital stocks will be reactivated, and that's exactly what they're going to use. They're going to use oil and gas. So As we go forward, I don't think this is necessarily sort of we haven't seen the peak in demand yet. Eventually we will, but I don't think we're there yet. But I do think on the climate front, on the environmental front, there's a real appetite for some easy wins. And I think that actually sets in motion some real potential for some regulatory change as we move forward that doesn't involve massive costs to economic systems or governments for that matter, because we're talking about wartime budget deficits now. It's going to look really interesting over the next year.
Indeed.
All right, so we are up against it on time, and I know that I did not get to everybody's questions, and I've kind of woven what I have asked through, I think, the themes of a lot of the questions that came through. Without a doubt, there are questions that were not answered, and I apologize for that. But suffice it to say, we will be doing this again. So definitely stay tuned, and if you have questions, feel free to shoot them over, and we can try to get to them even offline. That's not a problem. But thank you all for attending, and please go enjoy your Friday evening as best as possible, and enjoy a cocktail, and look forward to better days.
Indeed. All right.
Thanks, everybody.
Thanks.
Thanks.
Thanks for coming.